Listen up, because right now, a single data point out of Washington is about to trigger what could be a multi-billion-dollar liquidation event. Seriously, one specific number has the sheer power to either ignite a massive market rally or completely wipe out leveraged portfolios across the globe. So think of this explainer as your macro alert. We're going to decode exactly what this number is, the mechanical chain reaction it causes, and most importantly, we'll walk through the 3 steps for survival that you absolutely need to execute to protect your capital.
Okay, let's start by looking at where things stand on the ground right now. $64,000. Bitcoin is already bleeding below this absolutely crucial level. And here's the thing, if this upcoming data print comes in wrong, we aren't just looking at a minor dip, we're staring down the barrel of a cascading wipeout. The entire market is basically holding its breath on a knife's edge right now, and every single tick below that 64K mark is just ratcheting up the tension for leveraged traders everywhere.
But make no mistake, Wall Street isn't just sitting around guessing what to do next. Institutional money has a strict, incredibly precise playbook for these exact moments. In this explainer, we're literally opening up that exact 10-minute macro playbook. By understanding how the big players shift their cash right before the trap springs, you can position yourself totally out of harm's way and, hey, potentially even capitalize on the chaos.
All right, moving into Section 1, the trigger decoding the US CPI. Let's get right into it.
So, you know the Consumer Price Index, right? The CPI. It's the alternate gauge for inflation. But you might be wondering, why on earth does a crypto or equities trader sitting thousands of miles away care so much about the household expenses of everyday Americans? Well, it's because the Federal Reserve treats this exact metric as its absolute holy grail for monetary policy. This single solitary data point effectively dictates the flow of global liquidity. When you crack open the CPI data, it's really built on 3 main pillars: housing costs, energy prices, and food inflation. Now, if these sectors run hot, the Fed is essentially forced to keep interest rates high, which effectively sucks liquidity right out of global markets. But if these costs start to cool down, the Fed gets to hit the rate cut switch, and that releases a massive tidal wave of fresh capital straight into risk assets. The whole shebang hinges entirely on these 3 slices.
Which brings us to Section 2, the target, Bitcoin's liquidation zone.
First things first, we've got to drop this fairy tale that Bitcoin behaves like digital gold during an inflation crisis. To Wall Street, institutional money treats crypto as a high beta, risk-on asset. Pure and simple, we are facing a massive binary event here. If that CPI number comes in hotter than expected, the Fed pauses rate cuts, the US dollar spikes, and Bitcoin drops. Boom. But on the flip side, a cool CPI confirms rate cuts, which plunges the dollar and sends Bitcoin absolutely rallying. Let's actually walk through the mechanical chain reaction of a hot print, what we call the liquidation cascade. It's like dominoes falling. It starts with the data coming in hot. Instantly, the market realizes inflation is being stubborn, which freezes any anticipated interest rate cuts. Because those rates stay high, yields on safe US Treasuries spike. That causes the US dollar index to surge. And the result? Institutions violently pull their capital out of speculative assets to lock in those nice risk-free returns. That sudden vacuum of cash triggers a massive leverage wipeout, potentially dragging Bitcoin all the way down to the $60,000 zone. But let's look at the other scenario. A cold CPI print is basically the ultimate signal to the market that the inflation beast is dead. It gives the Fed the absolute green light to pump liquidity back into the system. And you guys, this fresh liquidity is the exact rally fuel needed to push Bitcoin completely out of its current slump. It reverses that downward pressure and propels it aggressively towards $68,000, and likely beyond. Okay, Section 3, the collateral damage, global stock markets.
It's important to remember this shockwave isn't isolated just to crypto. Institutional heavyweights have recently been pushing their S&P 500 targets higher, but that entire bullish thesis relies completely on monetary easing. When U.S. interest rates stay high, the dollar strengthens against major global currencies. This acts like a giant magnet, forcing international investors to pull their capital out of emerging markets and tech equities and rush it right back into safe U.S. cash reserves. Conversely, low rates trigger massive foreign institutional investment inflows abroad. Literally, a single percentage point deviation in the US CPI shifts billions of dollars across global exchanges in milliseconds. All right, here's what you came for. Section 4, the escape plan, your tactical playbook. Knowing all these mechanics is totally useless if you don't know how to navigate the volatility, right? If you're active during a major CPI release, please do not try to play hero. The first 15 minutes are just pure algorithmic noise.
I'm talking trading bots specifically designed to hunt stop losses on both sides of the order book. So here are your 3 steps for survival. Step 1. Maintain 0 high-leverage positions during the data release. Just step away, lower your leverage, or stay in cash until that initial algo spike clears out. Step 2. Watch the US dollar index, the DXY. This is your true directional signal. If the DXY dumps, it means the market is officially pricing in rate cuts and risk assets are going to rally. And step 3. Track that $64,000 Bitcoin support hold. But don't obsess over the minute chart. Wait for a clean daily candle close either above or below the specific line. That daily close is what actually dictates your true macro direction.
By sticking to those 3 survival steps, you completely separate yourself from the algorithmic chaos and actually align your portfolio with the real macro trends. You've seen the data, you understand the mechanics of the liquidation trap, and you know exactly how the institutions are positioning themselves. So the only question left for you is, what's your read? Are you bullish on a liquidity pump, or do you think stubborn inflation is about to trigger a much deeper correction? Stick to the playbook, keep a close eye on those support levels, and trade safely.